These ETFs can change your portfolio forever. More growth, more income, and global diversification. Today, I'll show you the 10 best ETFs with which you can invest your money safely and profitably for the long term. Some of them are well known while others are almost unknown. Which ones they are and how well they're performing, you'll find out now on Northern Finance. My name is Alex Black.
Hi, my name is Alex from Northern Finance. This video was translated with the help of AI so that we can reach more people in their own language. A native speaker has reviewed the translation. Still, some sentences might sound a little unusual. Thanks for being here and enjoy the video now.
Let's get started right away. I should mention right at the beginning that returns are of course not guaranteed, but these ETFs offer the potential for high returns. First, we'll show you 4 growth ETFs that you can use to further enhance your portfolio's return opportunities. After that, we'll look at 3 ETFs for more dividend income. And finally, I'll show you 3 exotic ETFs for more diversification in your portfolio, which many people are missing. Let's get started right away with number 1, and that's the VanEck Defense ETF. I have added this particular ETF to our investment list because defense has truly become a significant megatrend, especially prominent in Europe, and is now viewed very differently from an ethical perspective than it was just a few short years ago. Many people are now willing to invest in defense who were previously strictly against it. Whether you choose to do that is entirely your decision. Personally, I have to say I would be open to it. As the name suggests, investments are made not only in Europe but worldwide in defense stocks, so in many different parts of the defense industry and the value chain. The ETF benefits from rising global defense spending and the recent geopolitical instability, and it costs 0.55% TER per year, which is okay for a thematic ETF. The ETF has also broken all records and became the largest thematic ETF in all of Europe just 2 years after its launch. Pretty impressive. What's special is that not only has the return since April 2023 been 173%, but more importantly, there's hardly any correlation with tech stocks or the broader market. That's why the ETF is very well suited as an addition to a portfolio. The top 10 are relatively well known but not super famous. Defense companies, we have Raytheon, Thales, Leonardo, Palantir, very well known from the US for big data analysis, Saab, Hanwha Leeds, Curtiss-Wright, Elbit, and Booz Allen Hamilton. We can see the geographical distribution here, and the ETF is also available in savings plans with all well-known providers. You can also find all ETFs and the ISINs of the ETFs linked below in the video description, and all the ETFs we talk about today can be included in savings plans with the major providers. And if you like this video and find it valuable, please take a second to give us a like and subscribe as a big support. Thank you at this point, it means a lot to us. And now we continue with the growth ETFs with the next 3. You can buy ETFs especially cheaply at Freedom24, including free shares that can be worth up to 500 euros. You can also find the link and a 48,000 euro real money test linked below in the video description. Now we come to the VanEck Video Gaming and Esports ETF, which isn't just interesting for gamers, it's actually quite intriguing. As you can see, in 2023, Americans spent 6 times as much on video games as on movies, and this trend is continuing worldwide. The ETF mainly includes really large companies, and in total only 25 companies, so relatively few. That's why the top 10 make up 59% and include Nintendo, Tencent, Aplovin, Roblox, NetEase, Take-Two, GTA 6 is coming out soon, EA, Konami, Capcom, and Bandai. Most of the stocks come from the USA and Japan, as well as China and Taiwan. This ETF is interesting for anyone who, like me, believes in the future of the gaming industry, and you don't necessarily have to play yourself. The ETF has become a bit more expensive in the meantime. In this case, it might make more sense to enter selectively during a dip rather than set up a savings plan, but of course that's a matter of personal preference. The ETF is also readily available for savings plans with all providers. That brings us to my favorite for maximum price growth, which I would also invest in regularly if I didn't have a cold wallet, the CoinShares Physical Bitcoin ETP. Investing regularly in a Bitcoin ETP, ETF, or ETN actually goes against the very concept of Bitcoin itself and the idea of being able to pay others and be autonomous from banks and the like. But for those who are simply after price growth, this is the right choice. This physically replicated ETN costs 0.25% per year, and the advantage is that others handle the custody for you. You can't lose your coins, which is the biggest risk for many people. But the biggest disadvantage when you use this is that your profits are not tax-free after 1 year of holding, as they are with regular Bitcoin purchases in Germany. Instead, you have to pay the standard 25% capital gains tax plus solidarity surcharge. It may be different abroad, but in general, buying Bitcoin is treated differently for tax purposes than buying Bitcoin through an ETF, ETP, or ETN. Since its launch in January 2021, it has delivered a 220% return and around 67% in the past 12 months. Next, we come to an ETF that can complement the previous one very well. It is to Bitcoin what a gold producers ETF is to gold, namely the Invesco CoinShares Global Blockchain ETF, specifically the fund. In my opinion, it invests according to somewhat arbitrarily defined criteria in companies that are then compared to all other companies as well as their trading volume, and they must somehow be active in the blockchain space. Here, you'll find Bitcoin custodians like Metaplanet and Galaxy Digital, but also completely different companies such as the broker Robinhood and Mercado Libre, which operates in e-commerce. These companies also hold Bitcoin themselves and are looking to somehow integrate blockchain into their business models. This ETF is only for people who are willing to take on a significant amount of financial risk, and personally, I think it includes too many companies that are only loosely connected to blockchain itself. So for me, it's out, but it could still be interesting for many others. Now let's move on to the dividend ETFs for more income. The first one is the Global X Nasdaq 100 Covered Call ETF, which you probably haven't heard of yet. Here, the stocks from the Nasdaq 100 are purchased and then options are sold to other investors, giving them the right to acquire these stocks in the ETF at a certain price. In return, investors in the ETF receive what's called a premium, meaning immediate cash flow. However, this also inherently limits the potential upside, precisely because you are effectively selling options on that very potential gain. If the Nasdaq 100 hits new all-time highs, the ETF will deliver less performance. If it performs poorly or moves within a certain sideways range, then the ETF will likely generate a bit more performance. Since its inception, the ETF has achieved a 26% return, but in the last 12 months only 1.8%, which is quite low. There was an increase to over 21% return, but then, due to Trump's tariff shock, it dropped to -6%. In comparison, a regular Nasdaq ETF earned 14.8% last year, so much better, but it doesn't pay any dividends. Here, there's less price growth, but in return, a very high distribution yield of currently 13%, which might also be interesting for some people. As you can see, that makes up a large part of the return, and every few weeks there's a dividend, which is pretty cool. The only major drawback in my opinion is that it's a synthetic swap ETF. If you don't yet know the difference between a swap and a physical ETF, we've linked our explanatory video for you, and it's also in the video description below. That brings us to the Vanguard FTSE All-World High Dividend Yield, which I personally find much better than the Global X Super Dividend. The reason is that the All-World High Dividend Yield includes quality companies, whereas the Super Dividend, in my opinion, does not. If we directly compare the top 10 holdings of both, you can see that pretty quickly. The Vanguard FTSE All-World High Dividend Yield has an expense ratio of 0.29% and has delivered a 150% return over the maximum period, but that's since 2013 to be fair. In the last 5 years, this value was a strong 86%, but in the past year only 7%. Here, investments are made in dividend stocks worldwide, and the top 10 make up only 11% of the entire ETF, which is pretty good. JP Morgan, ExxonMobil, Procter & Gamble, and the usual suspects are all included in this portfolio, and you have a dividend yield on the current price of 3.17%. This represents a solid value, and as you can clearly see on the right-hand side, the dividend income doesn't make up too much of the total return, which strongly suggests that there is still good potential for price growth in addition to consistent dividend growth. That brings us to the last dividend ETF before we move on to the 3 exotic ETFs for more diversification. So, the very last dividend ETF is the iShares Euro Dividend ETF for more income. As the name primarily suggests, it buys the largest and most established companies in Europe with the highest dividend yields that are specifically included within the Euro Stoxx Select Dividend 30 Index. The TER is 0.4% and it includes companies such as OMV, ABN AMRO, Signify, NN Group, the Italian Post, ASR, EDP, ING, Volkswagen and Orange. The country allocation is weighted a bit more towards the Netherlands than one might expect, and the financial sector currently dominates the composition. The ETF is already quite old, and for that its historical returns have been very low, it must be said. Since 2005, it's only achieved 134%, which is less than inflation for many, but in the last 5 years, things have looked quite different again with 87% return. Over the last year, we've seen a 28% return, which is also very strong. Due to Trump's new trade policy, these companies don't currently seem to be affected, as financial services and other service sectors, which dominate this ETF, aren't impacted by tariffs since services are exported without them. The dividend yield is 4.5%, and its contribution to the total return is relatively low this year due to the strong performance. However, in other years it can be quite significant. In 2021 and 2024, dividends made up around 80% of the total return, and in 2023 even more, so it can vary quite a lot. Historically, the distribution yield has been a bit higher and dividends are paid out to you every 3 months. This brings us to the 3 exotic ETFs for more diversification in your portfolio. First, we have the Xtrackers MSCI Europe Small Cap ETF, which tracks small cap stocks from all over Europe. This ETF has been around for a long time, since the beginning of the financial crisis in 2008, and even those who invested just before the crash would still have made a 265% return up to today. In the last 5 years, it has also delivered very good performance. The TER is 0.3% and dividends are reinvested. In total, there are more than 800 companies included within this analysis, and as you can see, the top 10 make up just under 6%, with the largest company being a very good example of the types of companies that are included. It is Belimo, a world market leader for cooling systems from Switzerland. Interestingly, the UK is also the most strongly represented, which I didn't expect, followed by Sweden, Switzerland, Germany, France, Italy, Denmark, and so on. The distribution across several countries is relatively even, and the sectors are not overly concentrated in a single industry either. A really interesting ETF in my opinion, and with that we come to the second ETF, which is the Russell 2000 US Small Cap ETF, the US equivalent, which also shouldn't be missing from large portfolios. The TER is also 0.3% and it accumulates its dividends, but it includes twice as many companies as the European ETF. The difference between the name with 2000 and the 1600 stocks actually included is explained by the use of sampling. That means the very smallest stocks are simply not purchased because it would be too complicated and too costly. This ETF has strong exposure to the American middle class, which can be a great addition to your portfolio. Just Nvidia, Microsoft, and Apple alone already make up 20% of the entire S&P 500, and out of 500 stocks, these 3 companies represent about 14% of the entire MSCI world, which is quite remarkable. That's why a bit of extra diversification here can be very useful if you want to avoid being too dependent on the big players. The return is 145% on the maximum chart and a solid 54% on the 5-year chart. The top 10 make up a similarly small portion of the ETF, so there is no concentration risk, there are fewer companies, and interestingly, unlike in Europe where industry dominates, here financial services are number 1. Still, a relatively large number of sectors are represented evenly. Finally, we come to an ETF that you probably haven't heard of yet, and that's the SPDR MSCI Emerging Markets Small Cap ETF. With a TR of 0.55% and dividends being reinvested, you're buying an ETF that has been investing in small companies in emerging markets since 2011 and contains almost 2,000 stocks. Over the maximum period, the overall return is a relatively weak 110%. Compared to the rest of the market, that's not much at all, but in the last 5 years since the COVID crash, it really took off, delivering a very impressive 72% return, which is indeed very good. The top 10 positions also make up a very small portion of the entire ETF at just 3.5%, and India is actually the largest country represented, which surprised me a bit. After that comes Taiwan, then South Korea, before we even get to China, which interestingly has a very small weighting. That also truly surprised me, since China usually has a much bigger share in many emerging markets. This way you can basically exclude or at least significantly reduce China somewhat if that's what you truly want. Many investors certainly share this particular opinion. The ETF is also broadly diversified across various sectors and offers a truly interesting opportunity to earn good returns far from the mainstream. Which ETF from this video is the best one for you? What is the best ETF for you overall? Let me know in the comments below. I look forward to the exchange, and with that I wish you good returns and see you next time.